To yours box. In this video, I'm going to go over the latest non-farm payroll report. If you like this kind of content, consider leaving a like. And I think in this video, as usual, is to be considered financial advice. So we got the jobs data. Came in slightly lower than expected, higher than I was expecting. In my previous videos, I made the case for a 105k print on the non-farm payrolls and a 4.1 unemployment rate. We actually got a 4.1 unemployment rate, so a 10th of a percent rise. Other data is came out as well. So we had weekly earnings, hourly earnings, coming in slightly below consensus, as well as participation rate going down, which was kind of a surprise, because like the second I saw 4.1, I was thinking that perhaps we saw perhaps the labor force participation rate staying flat or rising, but instead we saw a decline and an increase in the unemployment rate. We didn't see much of the impact on government payrolls. The reason for that is that the survey threshold is the 15th of February. So I would keep an eye out for that. That is probably why you see a lot of commentators on TV saying, be careful, because yes, this report didn't really settle anything. On the other hand, you might just have a build-up, and it'll just probably end up manifesting itself in the next payroll report, and the next one could be a bit more negative than this one here. Overall, my general expectation for this report was basically built on the PMI report and the ISM report that came out. So you read them, you put both together, and you kind of get, I mean, that's the way I go about it, and I kind of get the general vibe, if that's what you want to call it, of of how people are feeling in the economy. So again, if you put both things together, PMI report was really not good. The ISM was a bit more upbeat. So again, I wasn't expecting anything too dramatic from this jobs report. And as far as the unemployment number, the unemployment rate, I basically look at in initial jobless claims, and my threshold for any major shifts, okay, in the unemployment rate is basically the 215 to 220 area. Okay, so whenever you see initial jobless claims print below 215, you can generally expect a decrease in the unemployment rate. Anything above 220, generally speaking, you can expect a rise in the unemployment rate. The best example of that is what happened in July. Right here, we bottomed at 220 and we stayed above 220 pretty consistently until we peaked out at 250, and we closed the month at 234. But being over 220, which again, just to me seems to be kind of the break-even point for unemployment, it was enough to push the unemployment rate up to 4.3. Now, I don't think they've updated it on TradingView yet, but again, the labor force participation rate came in at 62.4, so pretty hefty decline. And that notwithstanding, the unemployment rate still went up. So you could also make the argument that had the labor force participation rate stayed steady, you could have also seen a bigger move in the unemployment rate. However, that's what we got. We got 4.1. And again, generally speaking, it doesn't really settle anything. I was expecting this kind of vibe to come out of the jobs report, as I said in my previous videos, confirming uncertainty. Okay, Um, being close to 160, you could make the case that bonds would could possibly retrace the trend line. Again, this is something I've been looking at ever since the breakout, simply because it's something that tends to occur. Okay, once we break out, it happened last year. You break out and then you just revisit it before moving on. This report could be a catalyst to to see that in bonds, for the simple reason that it's not bad news. Um, so it kind of gives risk assets some breathing room. Um, it could be that Bitcoin, resumes its uptrends, as well as stocks in general. I think that it doesn't really resolve anything, and so I think that the current environment still is valid, meaning that economic data has the priority over earnings and anything else. So the next catalyst that we have are really the same as last month, um, meaning keep an eye out for, well, the next data point, if I'm not mistaken, is around the 11th, where we have some inflation data as well as job openings. When is that? Yeah, right here, Tuesday 11th. Look for that, although this is slightly old data, but it still pays to keep attention, and it'll definitely move things around if it's anything dramatic. Having said that, again, it's just looking forward to what inflation is going to say next and what the economic data is going to look like. I think it kind of confirms the limbo we've been in since February, with a slight downward bias. Again, to be confirmed by the data. So, as things are now, if I had to, just get something out of thin air, it could leave a room for stocks to rally back up to the bull market support band and just retest it. And then if we were to get some, negative data, possibly get rejected by it, or if the data is good, then just plow straight through it. But again, when it comes down to the labor market report, the reason why I wasn't too excited about this one, again, it doesn't really matter, in my opinion, what the data says now. It's looking at this month's data, March's numbers, April and May, and you have to see how we get to the summer. Again, for me, my basic outlook is basically on the summer. Anything can happen between now and then. It's just a matter of seeing how the tariff talk and the layoffs are playing out. If they continue, if we keep seeing these sources of uncertainty continue to get fueled into the market, well, then risk off continues. If we see something that makes things change, like say Trump wakes up tomorrow morning and he says, what, tariff isn't it's no longer my favorite word in the dictionary, and it's all about tax cuts. Well, it changes completely. The scenario changes completely, and you have to reevaluate everything in there. But again, as things are right now, meaning the tariffs are still on the table, uncertainty is still strong, and we really don't have anything major, giving us a clear signal. Another thing to keep an eye on is the yen. We've continued to see yen strength, especially in the last few days. Keep an eye on this as well, because I made a video just earlier today, showing the potential risks connected with the dollar yen pair, and I think I'll leave it at that. Again, when it comes down to TLT and bonds, we did have a retest of the bull market button, which is nice to see. Um, Caught it, rule out a retest of the trend line. I can possibly. Time will tell, and in time the data will tell. So to summarize it all, we had 151 on non-farm payrolls, 4.1 on the unemployment rate. I don't think they still. I don't think they've updated it yet. Yeah, 4%. It still says 4%. It's 4.1. It's a small uptick, and I expect it to rise as we move into the summer. And I'll make another video on what I expect once we get to the summer. So yeah, it's same old, same old. Uncertainty. Uncertainty rules the markets. I'll leave it at that. If you like this kind of content, consider leaving a like, and I'll see you next time. Bye.